All right. So we were at this place. Okay, we were here. We were here. Hello?
Yes, I can hear you. Yes.
Good, good. So I was saying that in selling, you set your stop loss above your entering price, and your take profit will be below. But if you look at the buying, it's the opposite. You look at this one, your risk management or the stop loss would be below the entering price. So that is how it is. Yeah. So we get the calculation, assuming somebody buy Great British pounds versus USD, ask price is 1.5971. Be the ask price. That is the market price that you are buying. Now, when the ask price, then you enter. See that? So you enter and you target that you want to make at least 30 pips movement. The other day we were dealing with pips, and I said pips is just the 4 decimal place. When you pick the currency pairs, like this one is the pip position, and that is the smallest movement that the price can move. To start moving from this place, come here, come here, come here before here. So the person want to make 30 pips. Then the spread is 3 pips. So when you add this one to this, when you add this one to this, you'll get something like this. So it means that the ask and bid price that I was asking of, this is the real market price. But because of the spread, they add something like the 3 pips. So the real price that you are entering is now 1.5971. If there were no spread, then you just enter in this price straightforward. Good. And now you want to make 30 pips. So it will now be 33 pips because of the spread. So ask price is equal to this, bid price is equal to this. So as simple as that. When we get to the practical, you understand those ones better. We have the types of orders. We have orders and their types. So we have buy, stop, sell stop, buy limit, sell limit, and then the market execution. So these 4 types here are the conditional orders. They are orders that you predict that the price will get to this level, but then you will not be around to buy. So you set the system so that when it gets to that place, the system will automatically buy it for you. So those orders, we call them conditional orders. You only set them based on a certain condition. If the condition is met, then the orders will be executed. Otherwise, the order will be pending. So that is simple like that. But one is the market execution, that one, as soon as you click, the order will be filled automatically because you are buying it at the market price. So it will fill for you automatically. And you start trading. But where you don't want to start trading right now, you want to start trading maybe somewhere 12 midnight. But 12 midnight, you may be sleeping, but you also want to trade. So that's why you use this, your buy stop or buy limit. So they say order place above price and price keeps going up. See that order place above the price and the price keeps going up before it reach that price. Today the BTC is somewhere 41,000. Let's say you know that by 3 a.m. today, or let's say tomorrow, the price of BTC will be somewhere 45,000. But by then you'll be sleeping. You will not want to wake up. So you set the price, that higher price, while waiting for that time. So it will be going. If the price doesn't get to that place, then your order will not be executed for you. It will still be there. So that is a sell stop. Order placed below price and price keeps going down. So sell stop too is just the same opposite of the buy stop. You know that the price are going down and you want to sell. So you set the two, one is get to that place, then you enter the market. Buy limit, order place below price and price then goes up. You see, buy limit, sell limit. Buy limit is that order you place below price and the price then goes up. Sell limit to is order play above price and the price then goes down. I hope it is clear.
Somehow.
Yes. Mostly, if you have time and you are sitting by your computer or your smartphone, we normally use market execution. That one, if you just click, your order will be in the market. But where you use the buy limit, buy stop, and all that, if you will not be around, that is where you set it.
Yes, certainly.
Yes. You are telling the system that
I think I understand.
yeah, that while the price is moving up, but it will get to this level high. But that time, if I'm not around, the brokers will buy it automatically for you. So that is how it happens. And then what caused the price of currencies to fluctuate? We say foreign market, what do we do? Why is it? What made the price go up and down, go up and down? You see that? Number one, economic factors, growth of economy. Let's say the country economic factor can make the price change. If your economy grows, definitely your currency will grow. And when your currency grows, then you see that is your price not change, your currency price have changed. You see today, one US dollar is around 6.8 Ghana city. Let's say tomorrow our currency gain value. So it can grow and the USD will come down. So that is one factor, economic factor in every nations. Consumer spending money supply. Consumer spending, that is money supply. People buying and supply. People buying from you. The more people buy from you, the more your price is going up, and then vice versa. So that is simple like that. Current account balance, surplus or deficit. import or export. The import and export will make the price to fluctuate. When you import things from other countries, you see that, or you export, it will make the currency price change. Political factors, politics, and all that is also affecting the fluctuations of the currencies. Goods and services affect political instability. You see that? So that is it. Natural disasters, earthquake, tornadoes, flood, all these things. When there is a natural disaster in your country, definitely a lot of things will be destroyed. Your goods and services, a lot of things will be destroyed. So it will make your currency go down. Speculations, retail traders, hedges funds, retail traders, you are buying $1 from the market price, and you also go and add something small to it to sell. So all these things are what make the currency change. And the fluctuation of the currency that make us to get profit in the market. If the fluctuation is not there, then there will not be need to trade Forex. Yes. So market analysis. So all these things, before you enter the market and trade very well, you should analyze the market very well. So the analysis consists of market analysis, technical analysis, fundamental analysis, and then statement analysis, sentiment analysis, all these things. They are the analysis that we'll be looking at. Technical analysis, fundamental, and sentiment analysis. These are the types of analysis in the forex market that you must know. If you don't know these things, you can't trade. You trade and you lose all your money within 1 second. So that is why the analysis is very important. Okay. So when we say technical analysis is the framework in which forex traders study price movement. When we say technical analysis, just the matter of studying the price movement. You see that? So that you can predict the next movement of the price. And then you can make your decision to buy. And one is move like that, then you make profit. So the theory is that a person can look at historical price movements and determine the current trading conditions and potential price movement. The main evidence of using the technical analysis is that theoretically, all current market information is reflected in price. If price reflects all the information that is out there, then price action is all one would really need to make a trade. Now, have you ever heard the old adage, history tends to repeat itself? You see that? So they are just saying that technical analysis is all about studying the movement of the price, the graph, and the chart, the past events, and then current movement. You combine all together and you study it. So when you study it, you see that it moves like a patterns. And those patterns, when you see them, then it will confirm to you that the price will move up or it will move down. So when we get to the technical analysis, you will see them very soon. Fundamental analysis. Fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political forces that may affect the supply and demand of the asset. Just look at the market, look at the economic's impact to enter the economic and social and political forces to see whether those things can affect the demand and supply for you to trade very well. So that is fundamental ones. So you see this place, higher currency value, good economy, bad economy, lower currency value. If you study the currencies, you see that some are having higher, some are having lower. So that are having higher, they are the good currencies. Those that are having lower, they are the bad currency. Nobody would like to trade on the currency that is not having price. What happened to the green gold token? Because it doesn't have value, so nobody will buy it. What happened to multi-ball coin? It doesn't have value, people will not buy it. What happened to petrol tokens? So all these things, they don't have value, so people will not buy them. Sentimental analysis, and then you study by judging the price, compare it to others, compare it to different months, and see the difference. Types of orders, types of traders. In fact, everybody need to identify the kind of trader that you are. We are all unique.
Excuse me.
Uh-huh.
Excuse me. I have one question about the market analysis. There are three types of market analysis. One is technical, fundamental, and sentimental.
Yes,
Sentiment.
yes.
And from your experience, which is the most
I think the technical analysis
we
is
have
one.
to focus?
The technical analysis, yes, is that one that is the
If the 100%, what is the percentage for technical?
about, let me say, technical will be about 95%.
Ah, really? Okay.
Yes, that one is what we use widely.
So we should focus on the technical
Technical
analysis
yes.
most.
That is
Okay, thank you.
Yeah, thank you too. So I was saying that we must know the types of traders so that you know which trader you are. Every individual belongs to one type of traders. And if you identify the type of trader you are, it will help you to trade effectively. If you are maybe scalpers, you are trading day trader, you will not enjoy the market. So let's see the types of traders. We are the scalpers. The scalpers are those that are looking for just short terms, short term profit in the market. Let's say every day they trade short, and just be making their profit short. At the end of the day, they'll gather all and see how much they make per day. So those people, they are full-timers in trading. They are always there by their computers. So they can just look 2 minutes, 3 minutes, 5 minutes time, they make some dollars. 10 minutes, 30 minutes, they make some dollars. They'll just be trading within that time frame. So they are the scalpers. We are the day traders. The day traders are the traders that you don't have much time. Maybe you are working somewhere and you only have time for trading when you close from your work. So you can be a day trader. For them, they will play their trade daily. When they play a trade, it will take about 24 hours time before they will end it and wait for following day, 24 hours time. So they are the day traders. We have the swingers. Swingers too, for them, they are also playing their trade 1.5 days. Just say 1.5 days. It's more than 1 day, but it's not up to 2 days. They too they don't have much time. So they will be trading maybe 1.5 day, 1.5 day, 1.5 day per one trade, 1.5 day, 1.5 day in that order. So we are the position traders. Position traders have to do with, I was saying that buy and sell. When you buy, you make profit. When you sell, you make profit. So some will decide that they want to be buying alone all the time. Some too will decide that, oh, they want to be selling alone all the time. So those are we say positional traders. You take a position. So that is it. We have the mechanical. Mechanical, some they can also play their trade. It will take about 1 week. Long time investment. You see that? So that is it. It's very clear like that. So you know the kind of trade you want to be. Then you learn it research. Reading the Forex charts. So we'll be reading the Forex charts in that order. Types of charts that we have in the foreign market. We have the line chart, bar chart, candlestick chart. These charts are those that help us to make technical analysis. Without a chart, you can't make technical analysis effectively. And the types of chart we can use are the line chart, bar chart, candlestick chart. So these are all charts, but why do the people use candlestick more than all the others? Because they present to you enough information about the movement of the price. But line chart and bar chart cannot give you enough. They'll give you some basic information, but not all the information you need. Because of that, people use the candlestick more than others. So line chart, this is just the example of line chart. You see that it's in the form of line. So that is what we call line chart. Bar chart is the form of in the bar graph or bar. You see that? So that is it. And then bar chart in the quote, currency quote. This is how it will be like. Candlesticks chart. They are the most widely used chart as far as Forex market is concerned. So let's see why is the most useful and all that. If you pick any candlestick have 7 pass. Every candlestick have 7 pass. This one here is the upwards when the price is going up. So you see the arrow going up. And that one we call it a bull. This one, a bull. This one, when the price is going up, we say a bull, bullish, bull movement. And this one is bear. They are all animals, bear movement. So in the bullish market, or when the market is moving up, you see these candlesticks, mostly they are green in color. Some are red. The bear one is red. The green, the bull one is green. Just like the color, you just take the color like this. So you see them moving up, and this one too will be moving down. So now the candlestick have the opening price. The opening price is open at the bottom and move up to the top and close. It has the closing price too. And then this is what we call the wick of the candlestick. One is up, one is down. So it will tell you when the price open, how high or low the price has gone to. So lower low will tell you. And high here will also tell you. When you come to this sides, the opposites. And that one, the price will open from the top, because that one is coming down, close at the bottom. So that is different between them. So when you see the price is coming down, then you prepare to sell. If you see that the price is going up, you prepare to buy. As simple as that. So this is an example of candlesticks. When you open a chart, you'll be seeing these things. They are not there for fun. They are there for a purpose. And the purpose is to telling us the movement of the market. So you see, this one is the bull movement. That is the moving up. This one is the bear movement. That is the downwash. So there are always two, either green or red. And the red signifies that the price is coming down. And then the blue or the green signifies that the price is going up. So in that order. Very simple like that. Support and resistance. We are moving towards to the technical analysis, the deeper technical analysis. But before we get there, there are certain things we must understand. So that when we get there, we'll not see it to be like a Chinese film. You see that? You understand it better. So when we say support and resistance, when the price is moving, the market price doesn't move only one direction forever. The price moves in a zigzag form. It will move up, come down, up, come down, up, come down. This is the movement of the Forex market. So when it's moved here, it was moving from here up and got to this place, it could not continue. It means that there is something that stopped it. So that one we call it resistance. Something resisted the high movement and it came down. When it came here, something too came and supported here and it doesn't move further to the down. So that one we call it support. The base side is support, the upside is the what? Resistance. So the price want to move high to this level. It got here, it met some obstacles. So it cannot continue in that order. So there are supports and resistance. And they are forming part of the technical analysis. If you identify the support and resistance, then you can do the technical analysis very well. Plotting Forex support and resistance. So you see, this way, up is the resistance, down it was support. As simple as that. Very, very simple. 10 minutes time. Okay. But then we are gone far. So when we see this support and resistance in the downward trend, so the base line here is the what? Support. So up here would have been the resistance. So we have the resistance, plotting for a support and resistance continue. So up here is the resistance. Here is the support down. So they are like that. Trend lines. Trend lines are the lines that we draw on the chart in order to confirm the movement of the market, whether the market is going up or going down. You can use the trend line to identify it faster. So now, if you look at the market, Any foreign market have three ways of movement. At any point in time, the market will be executing one form of a movement. For example, if you look at this chart, this one, the market will always move either upwards, downwards, or sideways, or in a range. In a range, the market doesn't move up or down. It just moves at the same level going. But from here is the upwards trend. From here is the downwards trend. So that's what I say. These are three movements of the market. So if you want to trade, you trade when the market is moving up or when the market is moving low. We don't trade when the market is in a sideways. So that is simple like that. Trend lines continue. So they just illustrate how to draw the trend lines. So if you draw the trend line like this and it's up like this, then the trend is up. The market price is up. In the vice versa. So uptrend. We want to define what is uptrend, the characteristics of the uptrend, and then the downtrend. So we say that when we say uptrend, it means that the price is moving up. It will move from here, up here, come here, go up, come here, go up, come here, go up. So that kind of movement, go up, come down. When the market is going up and is coming down, we say retracement. Retracement. It's doing that. It's move up and come down small and rest. Continue up again, come down and rest small. Continue in that order. So one is the upwards trend. You see like this, higher high and higher lows, higher high and higher lows. This is a previous high. This one is taller than this. This one is taller than this. And this is the lows. This one is also like that. So that's the upward trend. We'll be seeing it in the candlesticks. Sideways. When the market is moving with sideways, this is how it should be. At the same size, so you can't make profit. How to trade the range? For the range, it's not advisable to trade. You see that? So that is it. But if you want to trade, this is how you trade. One is coming down, you will sell. One is going up, you buy. Just that the profit will be too small. Breakouts. We have something we call breakouts, and the breakouts are the confirmations of the technical analysis. We use those ones to predict and confirm it. Once the breakout, then you are about 95% sure that this trade, when you enter, you will get it. So that is what is mean. So if you want to enter a trade, after doing your analysis, this is how it will be. Let's say this is the market. So, and I come here, I see that the market was moving like this. But when the market came here, it was supposed to move down further, but it failed to move down. It means that the market is going to change its directions. It was moving down, down, down. Once you see this thing, then the market is about to change its directions from downside to upwards. So if you want to buy, then you can make your decision very well. And where to buy, you see the breakouts. This is what we call breakouts. This one. See that the price have come and will go higher than the previous high. So you can enter your trade here and then get it. When you come to the downward side too, it's in the opposite of the other one. So this one, resistance and support. Resistance and support, as we saw them. in this market too, it is the same thing. It's the same thing. So get a point. We are moving. Breakout, continued. That is what I just said. And then channels. Channel 2 are the lines you draw parallel to each other, and it will confirm that the market is either in a range, upwards or downwards. So this is how we will draw it. We draw one line here, we draw another one here. You see that this one is up, this one is down, this one is up, this one is down, this one is in a range, in that order. Important thing to remember about drawing trend lines. If you want to draw the trend lines, you must follow certain things before you can draw. So that is why they say the important thing to consider when drawing a trend line. Number one, when constructing a channel, both trend lines must be parallel to each other. When you are constructing the channels, these ones, these are the channels. So they say these lines must be what? Parallel to each other. They shouldn't cross each other. When they cross, then it's not more a trend line. So this one they said, when constructing a channel, both trend lines must be what? Parallel to each other. Generally, the bottom of the channel is considered a buy zone. The bottom of the channel is considered a buy zone, while the top of the channel is considered a sell zone. Like in drawing trend lines, do not ever force the price to the channels that you draw. The channel boundary that is sloping at one angle, while the corresponding channel boundary is sloping at another, is not correct and could lead to bad trace. So all that they are saying is that if you are drawing a trend line, you have to set it well. Don't let it cross each other. Don't force price to fall on inside it. Let's say this one. This is the trend line here. This is another trend line, another trend line. They are trends line. They say that never force a price into this. Let's say this price level, you want to make this price level to touch here. So before you do that, you have to bring this one closer. And then by so doing, a lot of distance should be on them, which is not the case. So that is it. So now we have done a lot. First of all, we start looking at the